What is the optimal capital structure for a company?
I would say, James, the optimal capital structure is a very bespoke formula, and it's based on a number of different factors. It really depends on what the deal is. Is it a growth financing? Is it an acquisition financing? How much risk the founder wants to assume, and how transformational that specific deal is to the overall company that is the acquirer. So it depends on a lot of different variables. You just can't cookie cutter that answer. But usually it's a fair amount of debt capital supported by a good amount of equity capital. Is that what you see?
Yeah, no, I absolutely see it. And when we're engaging with a client, the first thing I'm going to ask is who are your shareholders and who are your lenders? Because it's important to understand who the parties are once we get to that transaction. A lot of times we'll get down the path of a transaction and we'll discover a lender at some point in time, either through a UCC search or whatever. And understanding how much debt's owed and what they're utilizing that for is critical. The other thing that we get into as well is a lot of times you have founders that have 100% of the equity, and they don't like to give up the gold per se, and that's
Right.
a tough conversation to say. And I typically will respond with, well, you've got the pie the size of this right now, but would you like a pie the size this big?
Right.
And give up a little bit to allow you to grow more.
No, that was the sort of the origin of Attract Capital, was helping founders bring in transformational capital without giving up equity. And so in our deals, we're helping them put together structures, financing structures that don't have equity, using their built up equity in the business, so that the lender comes in and provides 100% of the financing, but they have to have equity that they're rolling in. And in all those instances, you're right, James, like the founders don't want to give up any shares. And in many of the cases, they don't have to. As long as they're buying a company at a reasonable price. If they're overpaying, they're going to have to bring in outside equity. But if they're buying it at a reasonable price, then you can usually find a mezzanine lender or a unitranche lender to provide a debt facility that not only funds the acquisition at hand, but also gives that company a delayed draw term loan, which they can scale with and triple in size by continuing to borrow. So it's essentially continuous access to capital is what we see and what we like to give founders. So no equity dilution, more capital than they need that they can draw down over time, and a reliable, responsible financing partner who's going to respect what they've built up already.
So in your conversations, because a lot of the clients that we deal with, I find that they tend to be more averse to debt, and they like to pay everything off and have no debt. How do you get over that hurdle with them when the other question they have is, well, how do I grow my company?
I think it comes down to when the founders get to a certain point where they realize that they've tapped out on their internal growth through their existing product lines, and they need to do something external, which is usually an acquisition because they want to grow more rapidly. And they understand if they're going to do an acquisition that they need external capital. Now, where they get stuck is they go to the bank and they say to the bank, we need 10 million for this acquisition. And the bank says, I'll give you 2. And then they go back to the bank and they say, I really need 10. The bank will say, I'll give you 2.5. Then they're like, where am I going to get that extra $7.5 million? Yes. They think they can only get it from an equity investor initially. They think that all the private equity guys that are calling them all day long saying, do you want to sell your company? Do you want to sell your company? That they're the only ones that they can get it from. Where we come in is we say, listen, there's a whole world of lenders out there that provide cash flow-based financing, which is a multiple of your EBITDA that we can use to supplement your bank loan and to supplement the equity that you build up for the deal. And they become more comfortable with it when they understand how broad and established and how low risk the structures are. We're not advocating extremely risky debt structures to clients. It's usually about 3.5 times. It's very comfortable with respect to the debt service coverage ratio for the company. And I can show them the numbers that says, listen, you're only going to get this money if they think you're a really good company, if they think that you can really integrate the acquisition, and if you could run at a debt service coverage ratio of about 1.25. If you can do all those things and keep the leverage within 3.5 or 3 times EBITDA, you can get the money. And that's how the lenders think. And usually it takes some time, but the founders are ready to take that step because they understand that in order to grow at a more rapid rate, they have to work with external capital providers.
I totally agree.
But it is a tough conversation.
It's a very tough conversation, and they have to think about it, and they have to talk to their families, or they have to talk to their key staff members or whomever else. And as simplistic as I can keep it with the conversation,
No, I
mean,
understand.
it's look, if you're going to borrow money, whatever you're borrowing money to redeploy it at, it's got to be growing at a rate that's strong
Absolutely.
enough to absorb that debt cost. And a lot of times when they hear that, that's when it kind of clicks on them, and I'm like, all right, come meet Dave Barnett, because he's going to actually explain it to you, because that's where my limitations live.
No, but the key thing is, James, with that point is, I think most of these founders have only experienced their local bank and the decision making that goes on. Once they meet the acquisition financing lenders, who are a whole different level in terms of their experience, in terms of where they've been, in terms of how they can help you, I think they have a better understanding of how they could make it work. So there's a different culture. I'm not going to say it's better or worse than the banks, but the banks are much more restrictive. And if you get sideways with your bank's going to kick you out of the portfolio. These lenders are much more patient. They're more understanding. They understand the ups and downs of long-term growth.
Yep.
And they've seen a lot of things. So, and you're also paying them more. So you're paying them a bit more, and they're going to be patient as a result. So it's a psychological discussion, and it's an emotional thing in terms of getting a founder comfortable.
Yes.